Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Is TRID slowing you down? Not if you're closing with UWM. While other lenders are struggling, we're closing most TRID loans in 15 days or less, thanks to easy-to-use tools like UClose and Ease, and direct communication from submission to close. Get United at UWM.com.
Welcome to Master of the Markets. I'm Barry Habib at MBS Highway. This is created exclusively for Mortgage News Network, brought to you by United Wholesale Mortgage. Great tools for you, like UConnect. What does that mean? Well, they look at your pipeline, and when your customers that you've closed are in the market for a refinance, they'll alert you, hey, that's especially valuable right now with interest rates so low. People are refinancing. You know, last week we did get some real important data, jobs data. The job creation is much stronger than expected, but the thing of it is that hourly earnings were a disappointment. Instead of going up, they're going down. Why is that? Well, here's the reason. The previous month, they were raised because they were forced to rise due to the increases by 14 states in minimum wage and Walmart, the world's largest employer, increasing their minimum wage. So that set the bar high. Now, without that, you get a truer reading of where wages are. And wages are actually going down. They're not moving. What does that mean? No wage pressure inflation. That means interest rates kind of like the fact that there's no inflation, and that's why we didn't see a real negative move in rates after a very strong jobs report. We normally would get that. This kind of paints the Fed into a corner, and that's meaningful because we're going to see a Fed meeting this week. Now, you know, we said there's no way the Fed's going to hike in March, even though all these pundits on TV back a couple of months ago were saying, oh yeah, March for sure, March hike for sure. We said no way, and that's not going to happen. They're not going to hike this week. But here's the problem that the Fed has. Their inflation indicators, the CPI and the PCE, are both moving higher. This means that there's inflation that they have to watch out for. And the PCE, which isn't really as good as the CPI inflation indicator, and also what it does is it doesn't take into consideration housing or the out-of-pocket costs for medical, which are real costs that you should take into consideration. But the Fed's kind of been hiding behind this and waiting to hike rates. So because of the fact that these two are moving higher, Fed's being pressured now to consider at their next meeting, not this one that's this week, to consider hiking rates, especially in light of these strong job gains. So what does that mean? Well, as far as the stock market goes, if that were to happen, then stocks would struggle. Remember the last time on December 16th, the stock market didn't like a Fed rate hike, and that pushed interest rates lower. If that were to happen again, I see the same scenario unfolding. But that means jobs would have to continue to be strong, and inflation numbers would have to continue to, at least nominally, tick up, and that would really pressure the Fed. On the other side of the argument, this week we're going to get the ECB, and Mario Draghi, perhaps the European Central Bank, perhaps may be doing some more quantitative easing. That will pressure the Fed even more to have to wait and sit on the sidelines. Why? Because if the Fed does indeed hike while China, Japan, and Europe are actually either adding QE or reducing rates, it makes the U.S. currency stronger. When our dollar is stronger, our exports are more expensive. That also means sales that companies make in Europe, when they bring them back to the U.S., you bring them back at a higher dollar rate, which reduces profitability. That hurts the stock prices. That hurts our economy. And that's one of the things that the Fed will be watching. It's a tough position that the Fed is in right now. We'll watch it. So what do we expect for now? Interest rates, watch 1.9% on the 10-year Treasury. That's the line in the sand. We've seen interest rates rise. They could rise to this 1.9% and then move back lower. But if interest rates on the 10-year Treasury break 1.9%, we could be in for a period where interest rates now start to move up a little bit. We'll watch this carefully. But of course, if 1.9% holds, we could be in for another refi rally. So very pivotal time that we're at right here. We're at 187 or so on the 10-year, so pretty close. Let's see where we go. All right, hope you guys have a great day. Bye-bye.
At UWM, our AEs receive over 500 hours of training each year to keep you current with the industry. We give you direct access to your own team of underwriters who return your calls in 3 hours or less. And we provide exclusive products and tools that give your business a competitive edge. In fact, everything we do at UWM is dedicated to championing your success, which is why more brokers choose UWM than any other lender. World-class service, exclusive products, groundbreaking tools, and you. Get united with us at UWM.com.
This is Mortgage News Network.